Hello, and welcome to today's KraneShares webinar, China Rising, Unveiling the Potential Drivers of a Sustained Equity Bull Market. My name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares Exchange Traded Funds. Today's webinar outlines our thesis that China's equity market rally is not a short-term bounce from oversold conditions. While many global investors remain infatuated with all things artificial intelligence, several improvements in China's capital markets, economy, and policy have occurred. Are investors positioned for a sustained rally? Joining us today is a special guest, Fawne Jiang of Benchmark. Fawne is an equity research analyst at Benchmark, covering China consumer and internet stocks, with an emphasis on travel and lodging, e-commerce, internet, and new media. Fawne was ranked #1 by Starmine in both 2019 and 2020 as a top stock picker. Prior to Benchmark, Fawne spent over 7 years at Breen Capital, leading their China research internet stock effort. Fawne started her Wall Street career with JP Morgan Securities as an investment banker, having graduated from Beijing University, where she double majored in economics and German literature. That's a whole nother conversation we can be having. Fawne obtained her Master's of Science from University of North Carolina at Chapel Hill and her MBA from Duke University. We are very privileged to have Fawne joining us today in order to review the Q1 earnings of Chinese internet stocks. Please proactively ask questions during the webinar as we hope for a lively Q&A post-presentation. If you're viewing on KraneShares.com, please email us at info@KraneShares.com. And for those of you joining us on Zoom, please use the chat function. I'll briefly give a description of KraneShares for those of you who are maybe a little bit newer to our firm. Our founder, Jonathan Crane, formed 2 core beliefs during his experience living and building a successful business in China. These 2 beliefs were the basis for founding KraneShares well over 13 years ago. The first was that while new China sectors such as domestic consumption, internet, e-commerce, 5G, semiconductors, clean energy, and healthcare have become the new drivers of China's economic growth, these sectors are still under-allocated in global portfolios and global indices. Second, the opening of China's mainland equity markets, the second largest in the world, will have a significant impact on investors' portfolios in the years to come as these markets are included in global indices. Most importantly, we endeavor to earn the trust of investors through our balanced perspective on China's economy and capital markets. China's rise in market indices, along with its economy, will necessitate investors have a partner to navigate these developments. KraneShares endeavors to earn that partnership role with you. We maintain a daily research blog that is available at www.chinalastnight.com, which we encourage you to subscribe to in order to keep abreast of developments as they occur on a daily basis. Fast forward today, we have a full suite of China exchange-traded funds, really focused on the growth segment of China's economy and capital markets. We've also taken a number of the investment opportunities that are occurring in China and applied them to broader emerging markets. Additionally, our product suite of exchange-traded funds listed both here in the United States as well as in Europe, which is all on the next slide, also includes our efforts in climate, which really started with our launching of the very first carbon credit allowance futures ETF globally, as well as we've launched a number of ETFs on behalf of friends and family and partners, such as Quadratic Capital from Nancy Davis Ivol, as well as Mount Lucas's KMLM, a managed futures ETF. Okay, so let's dive into the heart of the matter, just because I want to leave a lot of time. I need to find out from Fawne how she was in economics and a German literature. But before talking a little bit about specific to China, I think we got to take a step back. That I think we forget big picture that over the last, really call it 15 years, since the GFC low, the S&P 500 is up 945%. And that is just a very, very significant outperformance versus non-US equities. So if we looked at very simply all MSCI All Country World Index, so this is everything but the United States, that index is not even up 1/3 of the S&P 500. It's not even up 300%. So the S&P is up 945, ACWI ex-US is up 298%. That's from the March 9th, 09 low through the end of today. And certainly this underperformance is even more significant for emerging markets. MSCI emerging markets is only up 236, and MSCI China only up 150%. Now, I think what's key is that, one, investors recognize that 15 years is, we're talking about 60 times you have to open your quarterly brokerage statement, or an investment committee meets, or trustees or board of directors. It's very hard to stay diversified over 15 years. And certainly we think that there's a lot of pressure from investors to be very overweight US stocks because of the significant disparity between non-US equities, including emerging markets and China. But I think part of the problem is related to index construction, that if we looked at indices like MSCI emerging markets or MSCI China, they were 50% in two sectors, financials and energy. And that's really why KraneShares was conceived, was created, was to give you that growth element toward both China emerging markets, and obviously KWEB, but also KEMQ is our EM version of KWEB. And to prove that thesis is, if the benchmarks were so value geared, it explains why they've done so badly. So what is a growth sector within EM and within China? So obviously tech. And since the global financial crisis low, would you believe that EM tech actually beats the S&P 500? It was actually up 1,138%, beating the S&P's 945% return, but it was only 10% of the index. So the underperformance of financials, energy, industrials, materials outweighed the performance of the best performing sector. And it's even more so in China. Would you believe China tech, MSCI China tech, went up 1,761%. And the greatest example of this is, so again, MSCI China tech went up 1,761% versus the S&P's 945. So almost went up twice as much, but it was only 2% of the index. And an example of this is MSCI Chile is up not even 64% since 2009. Should there be EMX Chile ETFs launching? I mean, but the MSCI Chile index, it's all financials and commodity plays. So that explains why it's done so poorly. So this isn't, China, other emerging markets. And I think from a sentiment perspective, we're seeing, I think if you step back for investment professionals who have been doing this for a while, a lot of the headlines that you're seeing around, say, China today, they remind me of what it was like back in 2009. And in 2009, US investors walked away from US equities because the S&P 500 had a negative return for 10 years, 250% drawdowns. And so I think this idea of just as many investors felt the United States was uninvestable in 2009, we think a lot of those same views about China and emerging markets being uninvestable is a contrarian indicator. Now, professional investors are under the same pressure to perform. And on the next slide, there's a lot of work from sell-side analysts from both Morgan Stanley as well as UBS showing that the allocation to Chinese equities within professionally managed mutual funds is very, very low. That if you're benchmarked to MSCI emerging markets or Asia ex-Japan, or if you run a global mandate, this significant underperformance of not just China and emerging markets, but for non-US equities, it's very difficult to keep up with when the S&P is up 945 and your benchmark is only up 236. So that's why you're seeing in a lot of quote unquote emerging market funds, they're buying US stocks. This is a sign of the pressure professional investors are under to be overweight US equities. And I think that potentially could end poorly. Now this evisceration of the asset class, this difficulty staying invested in these long-running underperforming has led to very interesting comparisons. On the next slide, we show that with Amazon's market cap, you could buy all 32 companies within KWEB, and you'd still have more than $600 billion left over. I mean, does that make any sense to you? That Amazon has, in theory, is more important than the purchasing power of the 1.4 billion people who use the companies within KWEB? I mean, shouldn't we as an investor be a buyer at this situation? Now, at the same time, another example of the ridiculousness, this 15 years of outperformance, some of the consequence of that, and the pressure it puts on even professional investors is, would you believe that Alibaba has very little debt, but they do have a dollar-denominated bond. And on the next slide, we show that bond has outperformed Alibaba's stock by nearly 70% over the last several years. So again, you have a lot of investors. It's very difficult to explain to your investment committee, to your board of trustees, to your board of directors, why you hold these perpetually underperforming non-US stocks, and even more so for emerging markets in China. And so investors have very, very lightly positioned, very underweight to the space. And that I think really led to the decline in January of 2024, where we had a derivative-induced meltdown in both China and Hong Kong against this backdrop of underallocation. So on the next slide, we show that many derivative instruments that provided exposure to both China's Shanghai Shenzhen market or to Chinese stocks listed in Hong Kong, those derivative instruments gave levered upside, but they were called it's called auto-callable, which means as these derivative instruments that are based off indices, as they hit those significant price levels in indices like the Hang Seng or CSI 1000, it forces the issuing bank to have to redeem the underlying futures backing that contract. And because of this significant underallocation, there was literally no one on the other side to take the other side of that futures unwind. And so the markets really fell precipitously in January of this year in both China and Hong Kong, simply because of this, there's no one there to buy the dip. All the dip buyers have vacated the building. They've moved on. They're long AI stocks. It's the only thing that works. Why hold anything but AI, right? Now we think what's with any forced liquidation event, we think you should always be a buyer. Now that's just kind of more of an old Wall Street maxim that you always buy a liquidity event. But I think what we think is important is that, yes, we've had this very significant rebound following this liquidation event in January. But the question investors need to ask themselves is this rally sustainable? So on the next slide, historically, when we interact with our investors, there was a whole litany of issues that they would talk about. If it was China's internet regulation, if it's the potential US regulatory ADR delisting threat. Obviously, for several years, China's economy suffered due to zero COVID policy, the lives first policy. Real estate is an ongoing issue. Geopolitics. So this is part of the culmination of factors that have weighed on investors' confidence. But we think that while many investors, while they've gone underweight China, many of these concerns have either completely reversed themselves or maybe have just gotten less bad. Maybe things have actually improved. Now, one of the first things that's improved is China's economy itself. On the next slide, we highlight the Citi China Economic Surprise Index, which bottomed in the summer of last year. You might recall that recently China's Q4 GDP beat economists' expectations, that it came out at 5.2%. Not one of the 21 economists surveyed thought China's economy would be as high as 5.2%. Industrial production beat those same economists' expectations. Just today, the IMF raised their 2024 and 2025 GDP targets for China. So China's economy is growing. It's just growing incrementally. Now, on the next slide, part of this for this slow comeback has been that China's government is unwilling to engage in the free money stimulus that you saw here in the United States, as well as in many Western economies. That there's the belief that China's economy, it goes through cycles and it is improving. And they've used policy not to flood the system, but simply to nudge the economy along. And we continue to see economic policy support slowly push the economy along. Now, one area where we've seen a significant amplification of policy support is around real estate. And real estate is there's a rationale for why we're seeing this significant uptake in particularly real estate policy support, is that real estate is having, as we highlight on the next slide, a negative overhang on China's economy, that China's economy is affected by the slowdown in property sales, as well as the fall in property prices. There's less the concern that China will have its Lehman moment because of a disorderly unwind of a distressed property developer. That from my time in China a few months ago, and I'll be going back this weekend, that the view in China was that the policymakers know that if you had a catastrophic default, it could create a financial crisis, which is why there's so much attention given to distressed players. But But where real estate is affecting the real economy is this: as property prices have fallen, it's led to property sales to decline. And if there's less demand for new property, then that means there's less construction workers, plumbers, electricians that need to be working, that there's less need for new home furnishings. So there is this downstream effect on China's economy due to the slowdown in property sales. At the same time, Chinese households have significant exposure to properties. Estimates run from 50% to 2/3 of urban household wealth being held in property. And so if part of their balance sheet has lost money for 3 years in a row, that's going to lead to conservatism in their expenditure. So we've seen domestic consumption come back quite slowly, even following the removal of zero COVID. But we are seeing what we think are the first signs of this spending hibernation thaw, that if you were going to start to spend more money, and what would be the first things you would do? Well, for myself, I'd take my wife out to dinner. Then maybe we would try to do a domestic vacation or an international vacation. And arguably, we started to see this in some of the Q4 financials of the restaurant stocks, as well as the travel companies like Trip.com and Tongchen, one of their competitors. I think one of the other things that we're seeing that's important for investors on the next slide is similar to this liquidation event that we saw in January. It's very similar to what we saw in the summer of 2015 when the Shanghai Shenzhen market had a margin-driven bubble burst. And because Shanghai Shenzhen don't have circuit breakers like we have here in the United States, the government went in and started buying stocks to stabilize the market. And we've actually seen that happen in the mainland China market, and that we know that their sovereign wealth, the Chinese government sovereign wealth fund, Central Hujian, has actually been talking about the actual ETFs and stocks that they're buying. And what's key is that you can actually see their footprints. Now, Central Hujian has publicly stated that they're buying financial stocks and particularly mega cap like the Shanghai 50 and 180 indices. And that's because they know they can influence. They're not buying the stock market. They're buying the stocks that have the most influence on stock market indices. So very important that they were seeing that, very similar to that we saw in the summer of 2015, this proactive policy. Now the other thing that's happening is that these stocks that they're buying are disproportionately the mega cap stocks that we hold in our MSCI China A ETF. And the reason that they're buying those names on the next slide is because those are the stocks that have the biggest influence, that buying the 300th largest company or largest stock in China really has no effect on the market indices. Or if you buy the top 10 companies, and we just believe that the MSCI China A50 index has the most exposure to these names that the Chinese sovereign wealth fund is buying, much more so than 300 stocks or 600 stocks. So very important there. Now the other thing we're seeing is that Chinese investors are very much proactively buying stocks in Hong Kong. So on this slide, you can see, I'm sorry, on the next slide, this is Southbound Stock Connect, where we can actually track mainland investors buying stocks listed on the Hong Kong Stock Exchange. And thus far this year, they've bought well over $30 billion worth of Hong Kong stocks versus 40 billion for all of 2023. So very significant buying of Chinese companies listed in Hong Kong by the Chinese. And I think part of why that's important is, if you think about this underweight to China, it probably started with US investors, followed by European investors, then Asian investors, and then finally Chinese investors. So we think the rewind back in will be Chinese investors buying China first. We then think it'll be investors in Asia who've been long India and Japan, maybe taking a piece of those profits and rolling them into cheap Chinese equities, something to be watching for. So first, the Chinese are buying China, but Chinese companies are buying their stock. On the next slide, we can talk about this with Fawne, but it's hard not to notice the huge buybacks that are taking place across the companies we hold within KWEB. You know, Alibaba, Tencent. I mean, Tencent's buying back stock every single day. Alibaba, very significant buyback. You have JD.com, and as well as Alibaba actually issuing convertible debt to fund their buybacks, that their revenues are in renminbi, so they issue a dollar convertible in order to basically buy back that dollar denominated stock, or Hong Kong denominated. So we're seeing very, very significant buyback yields across the KWEB companies. And at the same time, we do think that a lot of what's happening in terms of the underlying Chinese economy slowly improving, we're starting to see that show up in the balance sheets of the companies we hold within KWEB. Certainly on the next slide, the valuations have not really been a catalyst for investors to come back in the space. At the same time, what we are seeing is that as the Chinese economy incrementally improves, we think that's starting to flow into the balance sheets of the companies we hold. And we think that what makes KWEB unique versus other Chinese indices is its growth orientation. These companies that are geared to China's domestic consumption story, the internet names, are actually the fastest growers. Now, again, we've had a very significant meltdown in January of this year. And yet we've had, on the next slide, we show this very significant rebound. And I think one of the biggest pushbacks that we get when we talk to investors about this rally is there are concerns. And certainly, you know, we can't predict the future. Our counsel has been that there's, you know, we're not going to get into arguments of the US or Japan or India being overvalued. We're simply saying there's maybe an opportunity to take some of those profits and roll them into cheap Chinese equities. But I think, you know, some of this is a matter of trust that needs to come back, confidence investing. And I think one of the most important things that we've seen that investors talk about on the next slide is the geopolitical. And while we continue to have a lot of noise out of Washington, D.C., we do believe that there's been a sustained effort at a high level to balance, to stabilize the relationship. And you know, we were able to meet with the vice chairman of the CSRC a few months ago here in New York, and he spoke to subtle signs that, you know, being back in New York, he was reminded of how direct the U.S. culture is, but Chinese culture is not so direct, and we need to look for subtle signs and certainly President Xi meeting with President Biden is a not so subtle sign at the APEC in San Francisco. But since then, there's been a number of points, and I do think it's a very, very significant unsubtle sign that even just today, it was announced that the Washington, D.C. Zoo will receive pandas following similar announcements for both San Diego and San Francisco. So that's a very important signal, and we'll maybe show we're going to have another webinar in a few weeks with Terry Branstad, who is the Trump administration's U.S. ambassador to China, that we want to share Terry Branstad's insights. So maybe at the end we'll be able to show when that webinar is. But net, we are more constructive on the opportunity for investing in China. And the next slide, we do think there's a number of catalysts in terms of the incremental improvement of China's economy, the trough of the effect of the slow economy on earnings, that those earnings we think are improving. We're seeing China buy China, as well as Chinese companies becoming very shareholder friendly. I talked about the buybacks, but certainly we've seen a lot of dividends. Alibaba paying out I think it's about $1.64 this year, following their first dividend ever in December of last year. We're seeing continued policy support, particularly around real estate. So, and then against the backdrop of skepticism and doubt about this rally. So again, we'll kind of get to the opportunity to talk to Fawne a little bit. We've got some compliance slides. Again, if you have questions, please email us at info@KraneShares, or if you're joining us on Zoom, please use the Q&A button. Again, we offer the China Last Night research blog just right on www.china. It's a free research there. But definitely want to talk, Fawne, a little bit about we had one of the things we talked about was this spending hibernation thesis. And we first noticed this, and obviously we're big fans of your work, and certainly for institutional investors, we highly recommend you track Fawne down, and the good people at Benchmark. Certainly, we noticed was in Q4 that the restaurant names and the travel names first showed. I mean, obviously it's a year-over-year comparison, so it's a very low bar, but kind of seen that play out in Q1. So just kind of curious, big picture, kind of macro. I mean, obviously your work is mainly focused on the bottom-up individual stock names, but and again, for finding Fawne, please go to benchmarkcompany.com. But kind of curious your take on what you're seeing in terms of kind of the macro of China's economy coming back a little bit. Any thoughts around the kind of consumer discretionary oriented names and within the China space?
Yeah, totally. Thanks, Brandon. I have to say, I just want to before we get into the review of the quarters or individual names, it's probably interesting to just double click a few of the macro factor I think Brandon discussed earlier, because I think they're really relevant macro drop, I think, for the first quarter earnings to begin with. And I do think our discussion today is a very timely discussion. To Brandon's point, I think IMF just upgraded in China 2024 GDP this morning, and it's actually quite sizable, I think, upgrades. I mean, of course, that was really, I think, on the heel of a very strong or robust, I should say, first quarter macro growth. If you look at GDP first quarter, I think China printed roughly 5.3%. That was actually meaningfully above, I think, market expectation of a 4.7. And more importantly, I think I'm going to, I think, cite Joe Tsai, his comments. Joe Tsai is actually the chairperson of Alibaba. So I think China consumer all along have the capacity to spend. That's why, we're talking about saving rate hitting all-time high post-pandemic. It hasn't really come down yet. But I think because the economic rebound last year was very lackluster, at least below expectation. So as a result, I think cautious, I think consumers have been holding very tight on their on their, I think, purse string so far, depressed their spending all along, except, of course, to Brendan's point, some of the local services, experience-driven, I think, verticals, including travel. But interestingly, this quarter, we're talking about fiscal first quarter of the year, we actually see a cross-board fundamental improvement. So, for example, I cover roughly 20 Chinese ADRs. Only one of my coverage name missed the quarter. So, in other words, the rest of the 19 companies outperform to a different magnitude. And secondly, we actually see accelerated growth across board, starting from big caps all the way down, trickling down to the mid-small caps. PDD grew their revenue this quarter, roughly 130% plus. And if you look at Bob and JD, they were very muted last year. They actually accelerated their GMV to double-digit growth, which was very encouraging. So if you're looking at companies' commentaries, management across board have pointed to macro stabilization with improving outlook. And I think second factor I want to point out here, I think Chinese companies are getting more efficient. So we actually see margin expansion across board. Take Tencent, for example. I mean, their top line growth is roughly 10%, high single digit. But just because efficiency improvement, as well as the company's focus on high quality of revenue source, we're really looking at their gross profit, I think growth of 25% and bottom line growth of 30%. So we're talking about much efficient operation. And thirdly, again, across board, aggressive capital return to shareholders. I think 95% of my coverage name have issued dividends and announced their, I think, repurchase programs. Big cap names like Bob and JD have roughly 6% total capital return in combination of dividend and repurchase. And smaller caps, even more, I think, pronounced, like the companies like MO and YY, we're looking at 20% total capital return, so which is very substantial given the stock price. And lastly, another interesting point for me here is, I think companies big and small across board are embracing generative AI applications. And personally, I do believe that Gen AI is going to be a growth multiplier as well as, I think, efficiency catalyst. So all in all, again, not saying we're going to have a basically straightforward upcycle, because we're definitely still have challenges in pockets of the economy, especially the housing market. But at the same time, I feel like consumer sentiment has improved, company fundamental has been strengthened, and then they're more active engaged in shareholder return. So hopefully those factors combined will help to stabilize the sector with upside potential.
Yeah, I think it's part of what it's interesting is like a lot of what you're seeing is almost the recipe for the Japanese stock market success. That you have we're not seeing the government buying of ETFs like we saw in Japan, but there is some intervention. The BOJ I think owns like 80-90% of all equity ETFs in Japan, but you're also seeing the reforms that the Tokyo Stock Exchange, the companies are actually implementing themselves, buying back stock, and yeah, it's interesting to me just that investors haven't really connected the dots. I mean, obviously not everyone is as focused as you and I are, Fawne, but
I have to say, Brendan, I mean, some of this market connection is actually quite astonishing. So, like for example, if you look at the current, the basic market cap, Baba's net cash balance sheet, it's actually account for 25% of his current market cap. Baidu, we're talking about 50%. And then, Tencent, just their investment portfolio alone accounts for roughly 30% of the Tencent market cap. When it trickled down to the smaller cap, like mid to small cap is even more pronounced. Take Hello Group, for example, ticker MOMO, that's a live streaming business in China. Stocks actually closed today roughly barely above $5. They actually have $8 net cash. They're generating 200 million free cash flow positive. And the combination of their annual dividend plus buyback program can mean basically adds up to 20% total capital return. So that's actually the value proposition we're looking at here. So I do think, China in general, I understand there's a macro factor, the geopolitical factor, but I do think at this level, there's no shortage of, I think, undervalued gems for sure.
Yeah, I couldn't agree more. I mean, that's fascinating that Momo's trading below book. I mean, in the summer of 2015, we talked about, companies like Dang Dang and Perfect World actually took themselves private. And I think we've seen a few instances of, I know the private equity firm Bain Capital took a firm private, not directly, is more of a data center. But we haven't seen a huge amount of M&A in the space. I mean, obviously the big players are very big, but is that something that you would expect, that the companies actually take themselves private, or?
Yeah, I think a couple of factors, I believe. Number one, I do think most of the public traded companies, it's ADR side, because I cover more vertical leaders, they do have ambition, global ambition. So yes, they're sitting on substantial resources and cash balance, and there's moderation of growth in China. But these companies, just given their expertise, their technology, I think, toolkits, and I do think we're going to see more M&A on the global setting. So if you look at the revenue source, I mean, I have to say PDD is probably the best example. They launched Temu, that's the deep discounted e-commerce app, about literally 6 quarters ago, and tremendous growth from globally, from US as well as the Europe, Asia, across board. So I do think we're going to see more cross-border M&A that could take place. I think just basically one, to leverage their resources to go after faster growth, and on top, I think they could really replicate, I think, their expertise and their know-hows to revive, I think, their growth trajectory going forward.
That's interesting. With PDD, our friend Jonathan said, pointed out that PDD is the one company that hasn't announced a buyback, and my assumption is just they don't have to.
Yeah, I have to agree there. I mean, it's a tremendous stock. Arguably best performer, a little bit less this year, but best performer last year, but still doing fairly well this year. We're talking about 70% growth top line, bottom line this year. I think 30% plus next year based on the consensus. And stock right now is trading, low teens multiples, and they're essentially blow out every quarter. I think the concern before for Temu in their international business was they're really, I think they have been investing aggressively to fuel their growth. I think there's always a debate about whether they can ever be profitable, whether it's a sustainable model. But interestingly, first quarter, I think strong testament, based on our, I think, estimate, and Temu was actually inching towards break even. We're still looking at small loss, but substantially narrowed. Actually showed me again, it's only 6 quarters down the road. It shows you how I think strong execution and how leverageable the business model can be. So I think again, it's definitely interesting name for the space.
And one thing, Fawne, I know a lot of times around China, there's skepticism about some of the numbers from for the National Bureau of Statistics, which I do follow, and I thought the official numbers on online retail sales thus far have been much stronger than just broad retail sales. But but it might be worthwhile. I mean, how do you, do you use some of these data sources? I think it'd just be very helpful for people some of the folks joining to understand how you're using some of these alternative data sources to create your models, and that you're not necessarily reliant on traditional government stats or even from the companies themselves.
Yeah, totally. Brandon, to your point, I think beyond the public data, whether it's government or company release data, on our side, we do have a strong local network of experts because we're covering the space for almost 20 years, 16 years by now. We have established our expert resources across vertical because we cover internet and consumer net that really give us exposure to a wide range of industry, which is essentially the end market for our companies. So from that perspective, we do have our advertising network check, e-commerce network, and merchant check. So because we have been consistently following the space, and there's a continuity on the data side, which really give us, I think, substantial insight on where things are trending. So I have to say that's probably, for us, that's a very important sanity check on top of I think the macro published data.
Yeah, it's I always say these things are mobile surveillance devices.
Totally.
Everything you're doing on there is they can be bought for enough money. With your engagement with many followers of your great work like ourselves, what's been the pushback? I've been a little, in some ways, I understand some of the skepticism. But is it some of this just investors overweight US and AI? I think some element is just a matter of trust, of confidence. Just kind of curious your opinion, or what's been the main kind of pushback when you introduce, why is it up? Why do we think it's a good opportunity?
Yeah, totally. I think, be honest, the overhangs on the sector has been three major factors. One, macro. I think macro, being honest, is about perception versus performance. I think people, I think markets in general, investors as well, may have underestimated the disruption of COVID and the tolls it has taken on China. Because essentially China was actually on and off, right, in 3 years of disruption. And because we talked to a lot of business locally, big or small, I think people did not realize, because the extended period of lockdown, a lot of the economic ecosystem, especially at the micro and local level, was actually broken down like throughout the cycle. So, but once it's broken, it takes time to really establish. So that's why in 2023, we didn't really see a strong rebound from China, growth. I think people take that as a trend and believe that's going to be indicated for the future. It's actually the opposite, as my view. Like last year, because all these economic system, takes time to establish and for business to gradually coming back to their normalized, I think, business operation. So we didn't really see the momentum we were expecting. But now we're like fast forward 1 year beyond I should say by now that's a year and a half. I think beyond the lockdown, I do think there's more normalization of business because we see the more consistency on business operation that helped, I think, merchants or like manufacturers, I think, to stay investing. And secondly, I think there has been, policy swings in the past couple of years. I think there's debates about where the policy direction, but now this year, especially in the last couple of months, we definitely see strong signal on pro-growth, I think, like pro-growth policies. So that really has boosted, I think, consumer confidence substantially. Again, I think China consumers, they have the capacity to spend all along, but they did not want to because they were not sure about their future. But now, I think with more supportive policies, consumer sentiment has improved. That's actually the single most important thing. Considering China's growth, the three engines, and then export, the investment, government investment, I think we are really looking, out of steam, or at least that's a lever for the growth of China going forward. So consumer consumption is very important. So that's why I do think consumer turnaround is indicative or catalyst for China macro going forward. And second, of course, to your point, you discussed quite a bit earlier. So it's really about political risks. But I do think there has been ongoing conversation between the two governments, which I think for me is a new phase. So I think we could hope for more constructive conversation and more constructive direction from here. So at least I think it's not as bearish as before. So, and lastly, again, it's about fundamental turnaround. So a lot of these our companies, private companies, they went through a tough time, partially because of macro slowdown, partially because COVID. But now I think everybody's really get their action together, moving on a more efficient operation. So I think three things combined: macro, geopolitical, and also I think fundamental. Arguably, we should see a more positive, I think, risk reward for the sector as a whole.
Yeah, I do agree. I think there is a fundamental reason for some of the poor performance that when you shut your economy down or significantly curtail it, it affects the underlying stocks. And at the same time, these companies weren't put out of business. Obviously the rates of growth were curtailed, but markets are not, they're not, things probably pendulum swung from one side and now is at and so, yeah, I certainly agree that I think China's economy is coming back. And, I know one of the questions we had was just around, the conservatism of the Chinese consumer. It's interesting just to see how low interest rates in China are, that there's almost a disincentive to parking your money in cash. And certainly Chinese treasuries are down below 2.4% on their 10-year treasury. I think the 1-year deposit ratio is now below 2%. So there is the government seems to be almost disincentivizing the savings, but consumers have been a little bit slower. But it does feel like the government is trying to nudge consumption, that we've seen some policies around home appliances.
Okay. Related. And also another interesting indicator is, people have been waiting for the plenary session for a while. It's finally confirmed in July. So, that's typically, I think, a conference where economic, macro growth will be the top priority, will be the point of discussion. So from that perspective, it's actually showed certain level of confidence, even from the top down, on the overall growth outlook. So that's why I think if you talk to people on the ground locally, experts, economists, I think everybody, I'm not saying, again, it's not going to be straightforward, right? But at the same time, I think people feel like macro fundamental should be somewhat bottom out. We should look for more stabilized, hopefully normalized, sustainable growth from here.
Yeah, it's certainly, if you believe in economic cycles, things are getting there. And I guess one factor has just been this non-US equity space has been so tough that there might be less dollars in some of these active EM funds. I guess that's a little bit of a factor. One of the questions just around how much investment from the US has gone into Chinese stocks. And yeah, we've been fortunate at KraneShares, we've hung in there, but certainly for some of our competitors, it's the last, I had to update a presentation, and some of the stats were on the that a year ago there were, I think it was 64 or 62 China ETFs in the US, and now there's 34. And so
Surprised. Like it's, I have to say, I mean, that's also somewhat reflect, right, on my communication with the investors. We definitely have seen scale back of China exposure in the last couple of years. But same time, probably because I'm a fundamental analyst, so I'm a firm believer fundamental. So like besides China, I also cover Southeast Asia. It's very interesting dynamic. I saw my Southeast Asia coverage names last year versus this year. Last year they struggled because macro concerns, because also I think competitive dynamics. So you actually see this market leader that gets oversold substantially. So traded at huge discount, but still nobody wanted to touch them. But interestingly, once we flip into this year, we see again, similarly macro improvement in Southeast Asia countries, and Singapore just also I think upgrade their GDP outlook. Indonesia also improving. With that, and also interestingly, competitive dynamics has improved, at least stabilized compared with last year. So two things combined, you actually see our regional leaders are turning around, accelerating their growth, and also pointing to a improved growth outlook. And then, strong performance of the stocks year to date. We're talking about 60% on, C. So actually show, I think, yes, there's still I think investors in general will still focus on, I think, fundamentals. I think China is at early stage. I mean, first quarter is probably the first quarter we see a reaccelerated growth. I do think we should start from here as we continue, as the sector continue to improve, I think their fundamentals, and with, better, I think, top line growth as well as stronger earnings capability. I do think is a gradual, I mean, to build confidence, I think it takes time. So from that perspective, but I think we are probably, gradually and hopefully steadily moving towards that direction. And to a point, I mean, it has been such oversold and their own. So from that perspective, just from global asset allocation, I think any fundamental improvement should trigger, I think, more reallocation of the capital.
Yeah, I agree. I mean, I think, another factor is just, this outperformance of U.S. stocks been accompanied by a very strong U.S. dollar, that the U.S. dollar index is up about 40% since its low in 2011. So, non-U.S. equities have faced a real headwind, and, Fed policy will dictate where it goes. But yeah, I think there's a strong argument that some of the tailwinds for U.S. equities in terms of valuations, very crowded trade, potentially overvalued, contrast that on the China side. Yeah, we're definitely see opportunities. I know in your fundamental work, unfortunately, like ourselves, like we're investors, not politicians, but with a PDD, how do you navigate some of these trade sanctions? I mean, less around, maybe less of an issue for KWEB versus EV or chips.
Yeah.
There's been talk about DC targeting some of the way packages come from China. But is that something that's really modeled? Can you model that, or is it?
Yeah, I have to say that's definitely a tricky question. And also, I think that will probably continue to be the overhang on moving parts. I have to say Temu, PDD, Temu specifically. But that being said, I do think company have been prepared. I mean, as much I think they still should, I mean, at least they hope to grow their US market because this is really, one of the best market globally. But at the same time, we actually have seen the company allocating resources in other regions. We saw strong growth from Europe. I do think their growth this year were largely driven by Europe. as well as Asian countries. So I think my estimate is I think the US exposure right now should be like 30%. So I do think they will continue to diversify their revenue source, and then as much as the US is important driver for them, but I think there's a way for them to grow by the same time mitigate potential regulatory risk.
Yeah, and one of the events that we'll be hosting in a few weeks is, I mentioned, we'll have Terry Branstad, who was President Trump's ambassador to China, as well as our general counsel, David Edelman, was President Obama's ambassador to Singapore. So, geopolitics is something that continues to come up, and we can't. We're not saying we know exactly what second term policies from either candidate are going to look like exactly, but polling people who are part of that diplomatic process from both candidates, we think there should be some good revelations from both David and Terry. So this is definitely one to mark on your calendar. Tuesday, June 11th, we'll be rebroadcasting the webinar for our friends based in Asia. So don't, you don't necessarily have to stay up too late on our behalf, but definitely something. Please go to KraneShares.com to register. And I know we're at the hour mark. I mean, it's but Fawne, really great insights. You're our only repeat guest, and you just proved why once again. And certainly, again, just want to point out that for investors interested in Fawne's work, benchmarkcapital.com, is Fawne's Benchmark's website, where you can find Fawne's contact information. And certainly we've been, long-running fans of Fawne's great analysis and work on the China internet companies. And yeah, just very appreciated you staying up on our behalf. Like ourselves, this is probably your second job, the night shift. But yeah, thank you again, Fawne. Yeah, very much appreciative of your insights, and definitely a lot for us to look forward to, fingers crossed.
Yeah, it's an honor to be here, and thank you for our investor. Thank you, Brendan. So look forward to more update.
Yeah, thanks again, Fawne. Have a good night.
Good night.